Okay, this chapter we talk about pensions, and we won't talk about the other post-retirement benefits. So those are actually, I pulled those out of the PowerPoint. So we're going to just focus on pension plans. And pension plans are basically when a company provides for the retirement of their workers. So instead of paying into Social Security, like say government workers, they don't pay into Social Security, they pay into this pension plan, and the employer matches it, and then it's guaranteed to provide you with retirement income. Some corporations will have that as well as the people paying into Social Security, so they could get both. And what you hope happens is obviously the money is being set aside both by the employee and the employer. It's being invested and it's earning money and it grows over time. That's of course, the goal. So we have defined contribution pension plans and then defined benefit plans. So the defined contribution plan is a fixed annual contribution. So the employer pays 5% into this plan for the employee. A fixed retirement benefit plan is a little more complex, and it's going to be based on years of service, what was your annual compensation, what age do you retire. So like I, as a teacher, I have a pension plan, and it is that defined benefit pension plan where it is up to, if I've worked there 10 years, 20 years, 30 years, how old am I when I retire, all of that type of stuff. So it's a far more complex plan to maintain and to actually figure out what you're going to get. But when we compare them, a lot of times companies have shifted to those where they just set in a set 5%. So like your 401ks mostly are going to be set up that way, where the company's going to tell you, hey, I'll put in, a lot of times they do matching though, like you put in 6% and we'll match half of that. I worked at an oil and gas company that they matched it all. If I put in 6%, they put in 6%. That was the high as you go though. But that was great because then you had 12% of your pay going in. So again, that's what most companies are shifting to. Like I said, like public schools will have the pensions that are the defined contribution plans, which are a little bit harder to maintain. And then the thing is, then they bear the whole risk. So when we retire, we're going to get this monthly payment amount. Doesn't matter if their investments did good or did great. That's just kind of how those work. But again, I do think that it's a benefit. Like people would love to have the defined contribution plan because it does make you want to stay at your job. You want to get to 20 years or 30 years. So it definitely kind of attracts that type of a person that wants to stay there long term, or if that's the type of employee you want. But say you're more of a firm that your employees turn over every 5 years, it wouldn't even be worthwhile then to have the defined contribution plan, again, because your employees might not ever stay long enough to get there. So again, here again is showing you kind of where the risk lies. So notice that the red question mark is kind of where the risk is. So if we have the defined contribution plan, the risk lies more with the employee, because who knows what you're investing in? Is it going to do good? If it does bad, that's all on you. On the defined pension plan or the defined benefits plan, that's going to be the flip-flop. So the risky part is, are we putting in enough money now because we know how much we need to pay out our workers when they do retire? So the risk goes more to the employer on those ones. So then again, like we've got our different types of plans. So like I said, 401k is probably the most common one in the defined contribution plan, but there can be other ones, and it could depend on the size of the company. But I do think that the 401k is the most common. So then if we have that where we're giving 3% into our employees' 401k with every pay, then that's going to be an expense to the company. and they're going to have to put the money into that account really they're going to do it every pay. This is kind of summarizing it by the year, but really it'd be a every pay kind of a deduction, and the company would be required to put it into their accounts at every pay. Now then, the defined benefit pension plan, again, because it's more of a formula, then that is the one that we are going to set up a liability, because we're not putting it into a fund that employee has access to right then. You know what I mean? Like, you can't take an early withdrawal from it. So then they're going to calculate, okay, how much based on our years of service, what's the final year salary, what percent are we going to add to this pension plan? So then that becomes more of a mathematical computation. And again, it can be very complex. We're going to calculate in like the present value of the money. We don't know how long the people are going to live. We don't know how long they're going to work. All those things are uncertain. So again, makes it a little harder to estimate these plans. So what you kind of want to understand, though, is what goes into the plan account. So we can have, like what it's saying here is there can be pension gains or losses. So if our obligation is higher than what we expect, or then the return on our plan asset changes, it's either higher or lower than what we expect, those can create gains or losses kind of in that pension plan. So let's keep moving here. So then this is a good one, because you'll have questions in your homework that do ask you like these things, and you're going to want to know, okay, what goes into my pension expense? So service cost, that's what the employees have earned during their current year, that increases our pension expense. Interest that is accrued on the pension liability increases our pension expense. Our return on those plan assets, so we've invested this money, what did we actually get? That reduces our pension expense. If we have any prior service costs that need to be amended, that's going to increase it. And then we can have gains or losses, again, because most of this money is being invested somewhere, and you can make money or lose money in whatever that investment might be. So you want to know that. So I would write all those down, and those all are components of our pension expense. And then there's 3 different ways to measure it. So there's an accumulated benefit obligation, which uses their existing compensation levels. There's the vesting benefit obligation that this is going to say what are they entitled to get, no matter if they continue on and work for the next 10 years or not. What are they vested in? What did they earn as of today? And then the projected goes out into the future, and that's where we get into that present value computation and say, what do we think if they do work, and what do we estimate their future compensation levels to be? So we're kind of projecting what we think we'll owe in the future. And then this, again, just kind of shows you the different levels. So again, the vested is the bare minimum. That projected is the most, we estimate that we're going to owe in the future. Oops. And then again, this is just clarifying those. So a lot of times to be vested, you have to have 5 years of service with that company. Sometimes things can change that, like the oil and gas company I worked at, if we were acquired prior to you reaching the 5 years, you became automatically vested. So there can be like exceptions to that rule. And then sometimes it could be like where it's saying that you get 20% in the first 3 years, then 20% every year thereafter until you're fully vested at 7. So again, they could set it up in different ways, just to ensure that they're giving the money to the people, who stay. And then there's this Pension Benefit Guaranty Corporation that is overseeing it to verify that people don't have unfunded pension like liabilities, and they're just kind of protecting the pensions. So our projected benefit obligation, which again is that future amount that we're going to owe, like it says, it's less reliable. There's more estimates, but it's probably truly what we're going to owe. So then we're going to want those to be on our balance sheet and our income statement. And then these are things that change that projected benefit obligation. And then you also want to know this as well, because you'll have questions about this. So the service cost, so each year of service increases that obligation to pay benefits. Your interest cost, that is also going to increase your pension benefit obligation. And again, it goes into that discount rate, kind of factoring in the time value money. Your prior service cost, if the pension plan is amended, and then we're going to give the employee credit for services rendered in prior years, we will have to include that, and that will increase our pension benefit obligation. So again, just kind of, this is also showing you like the time value money. I believe in most of the homework, they'll just tell you the dollar amount that's associated with it. So here they're just kind of showing you, though it really is kind of more of a complex computation that we do factor into the time value money numbers as well. Yeah, so that's showing you that's how they came up with that present value number, to multiply it out to figure out what they're going to be adding. So that's kind of what this whole slide does. So then now we've got what was our pension benefit obligation at the beginning of the year. We added service cost to it. We added the interest cost. So then we notice the balance then goes up again at the end of the year. Again, factoring in those time values of money. Then we can have gains or losses that are not related to the stock market. These ones are more related to uncertainties that could happen, and then we're going to adjust it accordingly. So then in this case, we estimate that our original estimate was incorrect, so we had the 400,000. We up it to 420,000. So then now we have an additional 9,155 that we need to add into that pension benefit obligation. Then we can have other things too, though, like we could say maybe we offer employees a buyout on their retirement, so then they end up retiring sooner than we thought. Maybe life expectancies, I feel like in today's world, those probably go higher. So that would probably be more of a loss if we assumed those things. But those things can all change the pension benefit obligation. And then when we pay our actual retired people out, obviously we are no longer owe them as much. That reduces that pension benefit obligation. So then this is, again, a nice little summary table that you might want to jot those down, because, again, you're going to want to understand those. So service cost increases, interest cost increases, prior service cost can increase it. The gains or the losses could go either direction, again, depending on what happens. And then retiree benefits paid reduce it. So the assets themselves, as they set the money aside, or in many cases also withhold it from the employees. So the employer contributions, and again, if any employee, if there's matching contributions going in, they all go to a trustee, like a bank or a trust company, and then they're going to invest it. And normally they invest it pretty conservatively in stocks and bonds. We also, when I worked at the oil and gas company, we had like the state of Pennsylvania invested some of their pension money into our wells. It was a very good investment. It paid out very well. But they, they gave money and had an interest in the wells in Pennsylvania, and then they got a cut of all those royalties. So they can make it a variety of ways, but they definitely want to do something that is fairly conservative, so you're not risking the assets. So then here again, they give you an example, a real life example of how it changes. So we've got the money that was contributed. We expected to earn 9%, but we ended up actually earning 10%, so we did better. And then we paid out $38 million to our employees. So then we can see that kind of coming in. Again, we go with the actual return on the plan assets because that's really what we earned versus the estimate. And then we always want to report if there is an unfunded status. So if we know we've calculated out our projected benefit obligation and we compare that to the fair value of our assets, I mean, is it overfunded or underfunded? So if we have a higher obligation than we do assets, then it's an underfunded, and that's going to be a liability on our balance sheet because we owe it. And that's probably how it is in most companies right now, is more of a underfunded than overfunded. And then again, this is another nice little summary that shows you what goes into pension expense, what increases our pension benefit obligation, and what increases our plan assets. So again, a nice little summary page you could look at. And then this is just an example, again, showing the different, things with dollar amounts associated with them so that you could see what is that pension benefit obligation, what is all included in there, and what's in our plan assets. And then this ties out their expense where you've got the service cost, the interest cost, reduced by our expected return, any amortization of the prior service cost, and any amortization of the loss. Okay, so that just gives you more details of those going out year by year. Now, the one thing on this one, though, is it is showing you here that when we account for the return, we need to look between the expected return and the actual return. So our expected return is going to be that we're going to see that we actually had a $3 gain. We expected the 27. We expected the 27. We actually got 30. So we made the $3 or the $3,000 on that. Okay. It's the same slide. It's just each time I click it, highlights a different item on there. Okay. So then here we've got the amortization of that prior service cost. So if we are taking that, and there was an adjustment based on either our plan or that we were allowing somebody to get credit for work that they had done in the past, that would increase our prior service costs. And that declines every year. Okay, then we have our amortization of the net gain or loss. So the gains or losses are reported in our other comprehensive income on our statement of comprehensive income as they occur. And then we are going to record those then into this pension expense or amortize those in. So then here it shows you a summary of that. So, and again, where we would have a loss or where we would have a gain. So if we have a return on our plan assets, that obviously gives us a gain. If we had lower than expected obligations, that would give us a gain. And then the flip flop would be true to the obligation side of it or the liability side of it. And then they talk about the corridor. So it can't be, it's got to be within 10% plus or minus. So if the gain is too large, then we're going to adjust it. So it can be plus or minus 10% of that pension benefit obligation. And then if that gain or loss exceeds what they call that corridor, that excess is not going to be charged to the pension expense all at once. So then we're gonna slowly put it into our pension expense. We're going to amortize it out. So then here again, they show you that the amortization of that, again, within that 10% corridor. So the excess is the 15. We're dividing that by 15 years. So then we would have 1,000 or 1 that's going to go into that every year to amortize that net loss. And then when they record it, again, notice the gain or the losses, both of those are going into the other comprehensive income section. And then we're either increasing or decreasing the plan assets, and then increasing the pension benefit obligation based on those changes. And then here shows the kind of the full entry where we are recording our pension expense, increasing those plan assets, increasing that pension benefit obligation with that credit, and then amortizing those prior service costs, and the amortizing the net loss that's outside that corridor amount. But you do kind of want to look at this one to look at where do they go, because a lot of the problems will give you what's in this red box above, and then you have to know, okay, well, what goes to my pension expense, and then what goes into my plan assets. So here they're kind of breaking that out and showing it to you. But on the problems, you'll be expected to kind of know where those go. Okay, and then the service cost component here is separate from other components that are part of that pension expense. And then again, it's considered part of our total compensation costs. And then here shows you the journal entries. So if they are contributing cash into the plan, it increases our plan assets and decreases our cash. And then as we pay anything out, we're going to decrease that pension benefit obligation and then reduce the plan assets. So that's fairly self-explanatory. And then here, again, they're showing us what goes into them. And that's these ones are the trickier parts to just understand what goes in to the pension benefit obligation and what goes into the plan assets. I feel like some of them are more obvious than others, but just kind of maybe jot those down, because those will be the questions that you'll end up having on your homework, is what goes in there. And then here they're showing us that, again, they are underfunded, so they don't have enough assets to cover their liability. And then, like we said, these adjustments go to the OCI, the other comprehensive income. So we see those adjustments then come in here in our statement of other comprehensive income. And then on the balance sheet, you would have that net pension liability for the underfunded amount. So that was the difference between what's in our plan assets and what's in our pension benefit obligation. If those were ever equal, then you would not have a liability. You know what I mean? Because then you would have enough money. And then this gives you the pension spreadsheet. So I do think you have one of those in your homework as well. So kind of look this over and maybe go back to this as a guide to put it in. But it's just taking all of the items that we talked about, and then where do they go? Do they go in the pension benefit obligation or the plan assets? Do they go in pension expense? So notice like service cost goes into our pension benefit obligation, and then the offset, the other side of the entry, is pension expense. So that's kind of what you're getting at here. Then like come down to cash. When you contribute into the fund, we reduce our cash, and then it goes into our plan assets. So it's almost like just taking those rules and those journal entries and then putting them into a spreadsheet, if that makes sense. So hopefully, though, this will help you kind of do those ones.